Hello everybody, welcome to Talk About House. I'm Todd.
I'm Lana.
As you can see, we have scenery behind us. I'm not going to tell you what it is. Maybe you know. If you know what it is, put it in the comments.
Yeah, absolutely.
But it's a notable thing.
Yes.
It's a notable thing. Okay, so what we're going to talk about today is there's this scenario that U.S. defaults on the debt. That's coming up potentially here just in a week or so. And what that would do to mortgage rates. So some... Zillow or somebody did it, published an analysis that somebody had done, and I'll just give you the headline. Mortgage rates could increase to 8.4% if lawmakers failing to raise the debt ceiling. You know, first thing I noticed was it's grammatically incorrect, the title of this article. It should say if lawmakers fail to raise the debt ceiling, so that kind of thing. Now what I'll do is I'll put this chart up so you can watch while Juan and I are talking, because we got more charts and more stuff to come back. Okay, Juan, first of all, why would interest rates go up in theory if the U.S. didn't raise the debt ceiling and in theory defaulted?
So the cost of money would be more, obviously, because we're no longer a good credit risk. So a couple of things. First of all, that's never happened. It is possible, and I'm not saying that it couldn't happen. It is possible, but it's never happened. The second thing is we do have some experience with something similar. Those of us that have had a few trips around the sun can remember the government shutdowns during the Clinton administration, where the government couldn't agree on a budget, and we had government shutdowns, and that was really fun. The government employees got to stay home. And then what happened was they were all paid all their back wages, even though they didn't work. So in the end, who lost? Yes, you and I, the taxpayer.
Okay, so you can see this chart. Now, the problem I have with this is they just made up a number. At peak of 8.4% in September, and then they show literally interest rates for the next year. So my question is, if they're so in tune with exactly what's going to happen, I want to see the chart they made in 2020 that showed what home prices were going to do over the next 3 years. Because they obviously know what's going on. They would have, if they have the ability to foresee interest rates and exactly what's happening in the economy, they should have foreseen the home prices rapidly increasing 2021, 2020, 21, 22, and 23. They should have seen that, and they didn't see it. People don't even know what's going to happen tomorrow. They're trying to make this ridiculous prediction at 8.4%. And then you can see it trickles back down basically. So they don't know any knows what's going to happen. That I kind of had a problem with that. I'll read this other part of the article. The report predicts unemployment rates would increase sharply from the current level of 3.4% to a peak of 8.3% in October, which I think is exactly, 8.4% was the interest rate. But they're going to say unemployment will go to 8.3% in October. And they gradually begin to decline. This contradicts Zillow's baseline scenario, which expects unemployment to increase gradually from its current rate over the next 1.5 years and mortgage rates to decrease in the same time frame. So Zillow's saying mortgage rates are going to decrease and unemployment's going to go back up to what a normal unemployment rate is, which is not 3.4%, probably closer to 5%. And they expect mortgage rates to drop. They're saying this sort of, makes them both go up. But like I said,
So, the whole thing with unemployment going up, are they calculating in the furloughed government employees who are now not getting paid maybe? How are they coming up with that? I really question their methodology. And I'm not picking on Zillow, but I think that there's a lack of transparency in the article.
Okay, here's the last thing from the article. I really found this one a bit ridiculous with all the other stuff, and this is kind of why you have to be careful when you read something, especially where they predict numbers and stuff. It says mortgage rates surpassing 8% would cause a 23% decline in housing market activity. Well, so is it 23 based on now or 23 based on the normal? Right. Home sales volume is projected to decrease from its seasonally adjusted annualized rate of 4.3 million in April 2023 to 3.3 million in September. However, the impact on home value in the event of a debt crisis is relatively moderate. Home values would decline around 1% from current values until February and end up at today's value by the end of next year. So if we default, home prices will drop 1% and then be back up at the end of next year. In a no default scenario, which is basically we don't default, we move forward, home values are expected to increase by 6.5% by December 2024. So they're predicting between now and the end of 2024, basically a year and a half from now, home prices will be up 6.5%. And even if we defaulted, home prices would only go down 1% and then come back to the current amount, which is complete noise. Like, you could never, 1% happens month over month sometimes, and
well,
it's just aggregate noise.
And the 6.4% is such nonsense, because anybody will tell you that home prices will be up 6.4% in 16 months, because that's what they traditionally are. Home prices go up about 5% a year. So, if you're looking at 16 months, yeah, that's about 6.4%. So that's, again, so disingenuous.
Yeah, if I had to throw a dart in guessing home prices over a long term, I would just basically use about 4%, 4.5%, and just add the number and multiply that times number of years. So if you said, hey, Todd, what are home prices going to be in 10 years? I'd say 40% higher. They'd be 40% higher than they are now. If you look back, now, of course, if you look back 3 years, they're 40% higher. And if you look back 10 years from now, they're like double. But I think realistically, it's not unreasonable to say that 40% would be a sort of a reasonable number. But anyway.
So that's an interesting thought. So consider this for a moment. If you have $1 million house, because I like easy math, if you have $1 million house and conservatively it goes up 4% a year, so in 10 years you've made $400,000 on your $1 million. That's actually a pretty decent investment, particularly because it's a low risk investment, because there is really no chance of you not having an asset at the end of the 10 years, right? It's not like with a stock that the stock can just disappear. This is, you have a tangible asset that at the end of 10 years, you will still have something. So I think that's an interesting thing to think about, is how you can leverage your home to build wealth.
I think there's another interesting thing here, and that is that, on one is saying, the 400,000 appreciation on $1 million house. You probably didn't put all $1 million down.
Right.
So if you put 20% down, 200,000, and so you have 200,000 equity, and then in 10 years you have 600,000 equity. So you've basically, 3x'd. You've tripled your money. You went from 200,000 to 600,000 in 10 years. Pretty risk-free. I would call that pretty risk-free.
Right.
Now. But that's just because of leveraging, and that's one of the things we've always sort of been very bullish on housing, is that it's very easy to borrow very cheap money to invest in an asset that almost certainly will go up, and if it doesn't go up over the random day, months you picked, or years you picked, just wait and they will.
Right.
Like, there's at no point in history where you can't look back far enough and find a substantial home price appreciation. But the big thing for the article, really, one, I thought, was that the numbers they picked, I thought, were a bit ridiculous, and they're just completely guessing. And, to say mortgage rates would be exactly 8.4% in October if we defaulted is kind of ridiculous. And then, but they'll be back to normal in a year.
Right. So that's just the noise out there. I know you're hearing it, and so we wanted to address it too. What did you think of the video? Was it interesting? Did we discuss something that hit home for you? Let us know. We're always interested in your opinion. If you know where we are, please leave that in the comments. If you don't know where we are, just take a guess. So please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.